Well, if you're a trend-following trader or investor, you're probably happy with the way the commodity markets are reacting. We're here to talk to Scott Magnuson about that topic today. Scott, thanks for being here.
Thank you, Tim.
Well, when you talk about the trends returning to commodities, what do you mean by that?
Well, we've noticed so far in the year 2010 that a number of markets that are responding to the overall dynamics of the economy and sentiment that's driving prices right now, a much stronger trend component is developing, particularly in the gold and silver market, particularly in the currency markets as well. And as the dollar has been going lower and as confidence in the dollar is eroding, it's had an inverse impact on physical commodity prices. Obviously, a lower dollar value is going to spawn higher prices in energies. It's going to spawn higher prices in physical commodities, grains, meats, some of the soft commodities like coffee and cotton, and trend-following systems, basic, simple trend-following systems that some traders employ have done extremely well this year, as opposed to shorter-term swing-following or volatility-type trading because of that trendiness that's returning back to the markets.
Now, specifically on gold, we're reaching all-time highs or closing in again on that. So what's a trend? How does a trend trader know at what point? I mean, they're already talking about, is this a top? Do you think that's opposite of what they should be doing because they should just be continuing on this?
In the case of gold right now, the market is getting very toppy. It's getting extremely overbought. Not to say that it can't go higher, but there are a couple of different things that are happening this year that I think a trader needs to take note of. Obviously, we've moved up into new high territory. Fear has been helping to drive that, not necessarily inflation, but lack of confidence in how fiat currencies are being handled throughout the world. If you're not already involved in the gold market, I would not particularly advise getting up at these levels. In fact, I think we may have a fairly good correction in gold going into the results of the elections this autumn. And depending on how the political power shifts between the Senate and the House, could bring renewed confidence that maybe things are going to change, maybe there will be less spending going forward, and maybe we'll see a greater degree of stability, which would bring the fear element out of the metals, and you could potentially get a 15-20% correction in these metals. Longer term, I think the dynamics at play that have driven the markets up to these levels are still valid. And with the excessive amount of stimulation that we have applied to this recovery, there will be some price to pay for that down the road. And $1,300 gold a year or two from now may still look relatively cheap in the big picture.
Are you surprised that we don't see more broad inflation around? I mean, we've got the commodity prices that are rising, and yet we don't have we have people talking in the newspaper about deflation rather than inflation. Are you surprised by that?
I've been talking about deflation since the beginning of the year, and that the potential was there before we move into an inflationary trend. I think the thing that will ignite inflation most will be job growth. And with job growth will be wage price pressures. And then once wage price pressures come into place with a more healthy, robust growth in employment throughout the country, then I think that's ultimately going to manifest itself in higher consumer prices. And that might be the beginning of an inflationary trend. Without job growth and without a recovery in the housing sector right now, inflation is going to be relatively tame, and the prospects of deflation still exist, as is fairly evident with the Fed's recent statement about they may want to artificially stimulate inflation a little bit just so we don't go into a destructive deflationary spiral.
Scott, thanks for your time.
You're welcome, Tim.